Picture this. You're 58. You've worked for 32 years, raised 2 kids, and paid off most of the mortgage. And lately, on the drive home from work, you keep asking yourself the same quiet question. When you finally stop working, will the money just keep showing up? Not a balance you slowly drain and pray will last. Actual income. Money that lands in your account every few months, whether you get out of bed or not. That is the dream behind living off dividends. You own a pile of solid Australian companies, and a few times a year, they pay you a slice of their profits. You never have to sell a thing. So today, I want to answer that question properly. How much do you actually need invested to retire off dividends here in Australia? We will work out the exact number for a modest life, a comfortable one, and the full no compromises version. Here is the first thing you need to know because it changes everything and it is something most people overseas would kill for. When an Australian company pays you a dividend, it has usually already paid 30% company tax on those profits. Our system hands that tax back to you as a credit. It is called franking. So when you see a 4% dividend yield on the share market, the real grossed up figure is closer to 5.5% without you investing a single extra dollar. In the United States or the United Kingdom, dividend investors get taxed twice on the same dollar of profit. We don't. That one rule is the reason retiring off dividends is genuinely more achievable here than almost anywhere on earth. Right? Let's build this in 4 steps. First, the number you need. Then, the simple maths to get there. Then, the honest catch nobody mentions. And finally, the one small habit that quietly doubles your income over time. Keep that last one in mind because it is the part most people skip. Let's start with the number that actually matters, which is how much it costs to live. The Association of Superannuation Funds of Australia runs the gold standard research on this, and they break retirement into 2 lifestyles. A modest retirement, covering the basics with a little left over, costs a single person around $36,000 a year, and a couple around $52,000. A comfortable retirement, with private health cover, a decent car, the occasional holiday and dinner out without flinching, costs a single person just under $56,000 a year, and a couple around $78,000. And if you want the full version, overseas trips, a newer car every few years, never really checking the bill, you are realistically looking at $100,000 a year or more. And to make all of this concrete, let's follow one person through the rest of the video. Let's call her Sophie. She's the same age you just imagined, 58, and she's ready to stop working. For Sophie, a comfortable retirement is the goal. So let's hold that $56,000 in mind and work out what it takes to pay for it with dividends alone. Here is the maths, and it is genuinely simple. You take the income you want and you divide it by your dividend yield. Let me show you with one company first, just to make it concrete. Say a company's shares pay you a dividend of 4%. That means for every $100 you have invested, you get $4 a year paid to you in cash. So if Sophie wanted her $56,000 purely from a 4% yield, she would divide $56,000 by 4%, and she would need about $1.4 million invested. But here is where Australia's franking magic comes back in. Once you gross that yield up to around 5.5%, the same $56,000 only needs about $1 million. Let's run the rest at that realistic 5.5%. A modest single income of $36,000 needs around $650,000 invested. A comfortable $78,000 for a couple needs around $1.4 million. And the full $100,000 lifestyle needs around $1.8 million. Now, in real life, you would never put everything into one company. A sensible, diversified Australian dividend portfolio tends to yield somewhere between 4 and 6% before franking, so these numbers are the right ballpark for how most people actually invest. Now, you might have seen the official retirement figures and thought, my numbers look high. The superannuation body says a single person needs about $630,000 in super for a comfortable retirement, not $1 million. And here's the thing, both are right. Their figure assumes you also draw a part-age pension and that you slowly spend your savings down to almost nothing over your retirement. Living off dividends is the opposite idea. You never sell, you live only on what your investments pay you, and the nest egg stays whole. That extra security is exactly why the number is bigger. Now, before you screenshot those numbers, I owe you the honest version, because there is a catch, and the videos that skip it are doing you a disservice. Dividends are not guaranteed. They are not a salary. A company can cut them or stop them entirely whenever profits fall. This is not rare. Take BHP, one of the biggest companies on our market. In 2022, it paid its shareholders $4.64 a share. By 2024, just 2 years later, that had more than halved to $2.20. And during the shock of 2020, around a quarter of Australian companies cut or deferred their dividends. Imagine planning your whole retirement around a paycheck and then watching it halve. That is the real risk here. The good news is there are 2 grown-up ways to handle it. The first is a cash buffer, keeping 1 to 2 years of living expenses in a high-interest savings account, so a bad dividend year never forces you to sell shares at the worst time. The second is diversification. You don't lean on the big banks and miners alone. You spread across more companies and sectors, so when one cuts, the others carry you. And here is the part that makes the whole thing work long-term. Quality Australian companies tend to grow their dividends over the years, often faster than inflation. So the income doesn't just hold. Over time, it climbs. Let's talk tax, because this is where Australia spoils you again. Picture a company that earns $1,000 in profit. It pays $300 in tax, then passes you the remaining $700 as a dividend, along with a $300 franking credit for the tax it already paid. At tax time, you are treated as having earned the full $1,000, but you have already prepaid $300 of the tax. So if your own tax rate is below 30%, you get money back. And if your tax rate is 0, you get the entire $300 refunded to you. That last part matters enormously because of where you hold these shares, which is your super. Inside super, while you are still working, investment earnings are taxed at just 15%. And once you reach retirement and move into what is called pension phase, that tax drops to 0. So a retiree like Sophie, drawing fully franked dividends inside her super pension, can receive that income and the franking refunds on top, paying essentially no tax at all. That is about as good as it gets. Now, a warning, because this is the single biggest mistake new dividend investors make. Do not chase the highest yield. When you see a company advertising a 10 or 12% yield, your instinct is to think, brilliant, I will need less invested. But a yield that high is almost always a warning light, not a gift. It usually means the share price has collapsed because the business is in trouble or the dividend is about to be cut. Investors even have a name for it, a yield trap. The companies that actually pay you reliably, year after year, decade after decade, are the boring ones. The big banks, the supermarkets, the established miners, the telcos, they will never be exciting. But boring is exactly what you want when your dinner depends on it. So how do you actually build this without becoming a full-time stock picker? For most people, the simplest path is a dividend-focused exchange-traded fund, an ETF. In one trade, a fund like Vanguard's Australian Shares Fund gives you exposure to hundreds of companies at once, with the dividends bundled together and paid out to you. A higher yield version, like Vanguard's Australian Shares High Yield Fund, leans into the bigger dividend payers. 2 or 3 of these can do the work of a whole portfolio. But here's the question I have been building to. How does someone like Sophie get to $1 million in the first place? Because she didn't start there. Rewind 20-odd years, and Sophie was in her late 30s, putting aside $1,500 a month. Not an inheritance, not a windfall, just consistency. At a long-term return of around 8%, $1,500 a month grows to roughly $900,000 in a bit over 20 years. Bump it to $2,000 a month, and you cross $1 million inside 19. Start in your late 30s, and you are there before you ever reach retirement age. And this is the one small habit I told you to keep in mind, the part most people skip. While you are still building, you don't take the dividends as cash. You switch on something called a dividend reinvestment plan, and every payment automatically buys you more shares. Those new shares then pay their own dividends, which buy even more shares. It is a snowball. Your income quietly compounds on itself. And by the time Sophie flips the switch from building to living off it, her portfolio is paying her dramatically, more than if she had been pocketing the cash the whole way along. That is the lever almost nobody talks about, and it costs you nothing but patience. So let's bring it together. To retire off dividends in Australia, you are realistically looking at somewhere between $650,000 and $1.8 million invested, depending on the life you want. You get there by investing consistently into quality Australian shares and ETFs, leaning on franking credits to slash your tax, holding a cash buffer for the lean years, avoiding the high yield traps, and letting reinvested dividends compound for as long as you possibly can. If you want to take one real step tonight, here are 3. 1. Work out your number. Take the annual income you would want and divide it by 5.5%. That is roughly the portfolio you are aiming for. 2. Log into your super and check how it is invested. For most people, this is already your single biggest pool of dividend-paying shares, and it is taxed the most kindly. 3. If you are still building, find the dividend reinvestment option in your share platform or fund and turn it on. Let the snowball start rolling tonight. And if this helped the numbers finally click, share it with someone who needs this. Honestly, that is how this channel grows. One last thing before you go. If a fair bit of this was new to you, that's completely normal. Dividends, franking, the way super is taxed, none of it really gets taught to us. So starting to learn it now isn't being behind. It's just the sensible place to begin. So here is where I'd point you next. I've made one long video that walks through the whole financial picture for Australians, from the ground up, in the order it actually matters. Your pay and tax, then super, then debt, then investing, then property, and finally how to pull all of it together into one system that runs whether you're watching closely or not. Everything we talked about today, your number, your super, and the investing that gets you there, is one piece of that bigger picture. That video is the whole map, and it's the best place to start because everything else on this channel builds on top of it. It's right here, and I'll see you over there.